Good morning, this is Rob McDougall with Zhang Financial here with your weekly economic update. Today is Monday, June 10th, 2024. So last week, in terms of economic activity, we had a huge week, and particularly at the end of the week. So we'll start off chronologically, talk about ISM services that came in much stronger than expected. So it was expected to come in at 50.8, and as we often point out, this is scaled to 50 being the demarcation line between expansion and contraction. So you would hope it's above 50, and the consensus was 50.8, but it came in at 53.8. So services continue strong. Then on Friday was the big day. It was the jobs number day, non-farm payroll, unemployment rate, average hourly rate, and the non-farm payroll number was a huge surprise. In fact, there are over 35 analysts that are tracked on Bloomberg in terms of making an estimate for the non-farm payrolls number. Not a single one had a number close to 272. So it was 272,000 was the reported jobs created in May. We unpacked that, though, a little bit and suggest that we're not quite sure if that number is accurate or not. We'll just point this out. There are two surveys that are actually done by the Bureau of Labor Statistics. One is the enterprise number that I just gave you, positive 272,000. Separately, there's a household survey. So they simply go out to thousands of households, take a sample, ask if they've added jobs, taken another job, lost a job. So here's the difference. Enterprise going to the businesses, the 272,000 reported. Looks a lot different when you look at the household survey, which came in at a negative 408,000 jobs. So households are saying they lost 408,000 jobs last month, but enterprises are saying that they added 272. Obviously, that relationship has to reconcile at some point. We'll look for that in the future. Another thing that I mentioned in terms of the jobs data that we see once a month, the non-farm payroll, is a very common thing that occurs is the number is printed, it's positive, usually above expectations, but they always take down the prior 2 months, revise those estimates down, happen again. So both the prior 2 months adjusted down and a huge beat on the top line, the 272,000. So the markets definitely reacted to that. At first, it was quite negative. By the end of the day on Friday, I don't think it was as big of a deal. We ended up with a decent week in terms of equities and fixed income. We'll take a look at that. I think the investors, as we did, went through the release and took a look at the household survey and suggested maybe that labor market tightness that this might suggest is not really happening. We kind of think it's going the other way. So the other couple of metrics that came out on Friday, unemployment rate, that actually ticked up. So again, in contrast to that huge beat on the jobs number, unemployment rate actually ticked up 0.1%, purportedly because the participation rate went down. Also, average hourly earnings. Now, we track this for a couple of reasons. It cuts both ways. Do consumers have enough money to spend, or do they have too much to spend, and therefore inflationary impacts will result? This actually came in higher than expected. The month-over-month for May was expected to come in at a positive 0.3, but it came in at a positive 0.4. So in terms of market reaction and other data points from last week, we often, almost always, take a look at what the Atlanta Federal Reserve suggests the GDP growth might happen to be in any given quarter. And given the data that we saw last week, the Atlanta Federal Reserve took up their expectation for second quarter GDP growth back up to 2.7%, or up to 3.1% from 2.7%. So this hit is high. It was above 4 at one point, dipped down closer to 2, and now is at 3.1. And we're almost two-thirds of the way. We're over two-thirds of the way through the quarter. So inflation expectations, based on what we talked about for last week, inflation expectations, you might think with that jobs number and hot wages number, that the fear of inflation rising might have hit. Actually, the opposite last week. Came down actually very nicely. So the 10-year break even, 10-year treasuries minus 10-year tips, actually dropped 5 basis points. So the expectation for average inflation over the next 10 years dropped from 2.35 the week before to 2.3% at the end of last week. In terms of the Fed, this is a big week. We're going to mention it a little bit later, probably mention it again. Federal Reserve is meeting this week to discuss interest rates, and based on the information seen through last week, expectation is almost no chance whatsoever of any change, up or down for the Federal Reserve. Wednesday, they'll make their pronouncement and have a press conference afterwards. In terms of the next month out, which is July, it's actually at the end of July, July 31st, the expectations now are pretty much what they were a week ago, but it again is expecting no cut. Based on economic data we saw last week, it's pretty hard to make the argument that the U.S. economy is weak enough that we need an interest rate cut. So 91% probability built into the Fed funds future that in the July meeting, end of July meeting, no Fed rate cut. Now, for the end of the year, we always review these numbers. They moved a little unfavorably if you're expecting interest rate cuts. The odds of no cut actually increased from 12.9% the week before to 14.6%. And the odds of it getting at least 2 cuts by the end of the year, that came down a little bit further. It's 45.5%. Week before, over 49%. So investors are increasingly believing even 2 interest rate cuts this year. It's probably more than we're going to get. And recall, as we keep reminding you, coming into this year, the expectation is we were going to get 6 of them. But we again argue, as investors are, the economy is too strong to warrant the Federal Reserve to be cutting interest rates. So last week, based on that huge bolus of information that we got on Friday, how did the markets react? Well, equity markets up in the U.S., internationally, mix 2 up, and fixed income was actually slightly up during the week. So the S&P 500 up 1.36% last week, and below that, if you take a look, it was, again, a return back to large cap and growth. Large cap growth worked incredibly well last week. Last week, growth was up 1.1%, let's call it. But U.S. large cap was up 1.9%, and U.S. small cap down 1.9%. So on a year-to-date basis, just to review, S&P 500 now is up 12.8%. And within that, growth value almost the same, but large cap has outperformed small on a year-to-date basis. Now, international markets, the developed markets, ex-U.S., flat for the week, positive 0.3%. Emerging markets, though, up 2.3%. Part of that was China. China was up 1.55%. So now on a year-to-date basis, developed markets, ex-U.S., again, S&P 500 up 12.8%. The rest of the world, developed markets up only 5.4%. In emerging markets, even lower, positive 4.8%. Now, fixed income last week, we had the 2-year yield up. It wasn't a huge change. 2-year yield up 2 basis points, 10-year down 6 basis points. So the Bloomberg U.S. Aggregate Bond Index last week was up nicely, 0.44%. But on a year-to-date basis is still negative. It's a negative 1.21%. Because on a year-to-date basis, you may recall we had a huge bond rally last November, December. We've given that up. So the 2-year year-to-date, the 2-year yield is up 64 basis points, driving prices down. The 10-year year-to-date is up 56 basis points. So let's take a look at economic activity that will be released this week. A huge focus on inflation in Federal Reserve, as I mentioned. Wednesday, the Federal Reserve meeting, Tuesday and Wednesday, and press conference on Wednesday. So in terms of the data points for this week, on Wednesday, same day as Federal Reserve meeting, we're going to get inflation numbers, CPI numbers. We're going to get CPI, CPI core, month over month, year over year, FOMC meeting, as I mentioned. Then on Thursday, PPI, core PPI, and on Friday, consumer sentiment. So to unpack just a couple of those, core inflation rate, we'll just go with the headline. CPI expectation year over year is expected to come in positive 3.4%. For May, same as we saw in April. The month over month, though, is expected to drop from a 0.3%, positive 0.3% in April, to a positive 0.1%. We'll see on that one. Core inflation expected to come in year over year, slightly down, 3.5%. Month of April is 3.6%. Month over month, in line with what we saw in April, positive 0.3. Again, just finishing off on the FOMC expectation, of course, no change during that meeting. Now, PPI, Producer Price Index, and core PPI that comes out on Thursday. This will be very interesting because the expectation is we're going to see dramatic improvement in the month of May, lower PPI numbers in terms of inflation. So core PPI is expected to go from a positive 0.5% increase that we saw in April to only a positive 0.3%. And then the PPI headline number is expected to go from positive 0.5% in April to only 0.1% for the month of May. Lastly, for this week, Michigan's Consumer Sentiment Index will be released on Friday. Last month of May, it came in and it was very disappointing at 69.1. Investors are expecting some improvement in that metric from that 69.1 in May. Consensus is a 72 reading that we'll see on Friday. So that's it for the economic recap this week. Thank you very much for attending. We hope to see you next week. Thank you.